Imagine you have two neighbors. Same street, same year they started, same amount of money saved up, around $50,000 each. One buys a rental property in the suburbs, the other opens a brokerage account and drops everything into an index fund. 20 years pass. They both did well. Both feel smart. Both tell stories at dinner parties about how they just knew this was the right move. But here's the thing, nobody mentions at those dinner parties. One of them is quietly, significantly ahead of the other, and the reason why has almost nothing to do with the investment itself. It has everything to do with a set of invisible rules that most people never learn until it is too late to change their position. This is not a video telling you which one to pick. This is a video explaining how each one actually works, what the numbers really say when you strip out the stories, and why the debate itself might be the most expensive distraction in American personal finance. Stay with me. Let us start with why this question even matters right now in this specific moment in history. Because right now is genuinely unusual. The S&P 500 has returned roughly 10.5% annually on average over the last 100 years. That number gets thrown around constantly, but between 2010 and 2021, it did something almost obscene. It returned over 300% in 11 years. People who parked money in a basic index fund and went on with their lives almost tripled it. Meanwhile, home prices in the United States rose about 30% between 2020 and 2022 alone. In some markets, Miami, Phoenix, Austin, Nashville, the numbers looked more like a speculative bubble than a housing market. People were waiving inspections, paying $80,000 over asking, buying homes sight unseen. And then, interest rates did something they had not done in 4 decades. They moved from near zero to over 7% on a 30-year mortgage in about 18 months. Suddenly, the math changed for everyone. So the old arguments, the ones your uncle makes at Thanksgiving, the ones from a 2019 Reddit thread, they don't quite hold anymore. The landscape shifted, and the people who understand the mechanics of both assets, not just the vibe, are the ones navigating it clearly. Let us build that understanding from the ground. Here is how the stock market actually works, explained without a textbook. When you buy a share of stock, you are buying a tiny piece of a real business. If that business grows, earns more money, expands, your piece becomes worth more. If it does not, your piece loses value. Simple enough. Now, most people do not pick individual stocks. Most of the time, when people say they're investing in the stock market, they mean they're putting money into an index fund, which is a product that buys a little bit of every major company at once. The S&P 500 index, for example, holds shares in 500 of the largest American companies: Apple, Microsoft, Amazon, JP Morgan, Exxon, all of them, proportionally represented in a single fund. The core logic is this. The American economy, taken as a whole, tends to grow over time. Productive companies earn profits. Those profits get reinvested or returned to shareholders. Over decades, this compounds into something significant. If you put $10,000 into an S&P 500 index fund in 1994 and touched nothing, by 2024, accounting for reinvested dividends, you would have somewhere in the neighborhood of $200,000. No skill required, no research, no quarterly earnings calls, just time and inertia. That is genuinely extraordinary. But it comes with a cost that is psychological rather than financial. Stocks are volatile. In 2020, the market dropped 34% in 33 days. In 2008, the S&P 500 lost 57% of its value peak to trough. In 2022, the Nasdaq fell over 30%. These numbers look manageable on a historical chart. They feel completely different when it is your money and you are watching it disappear in real time, while also wondering if you should sell. Most people do not behave rationally in those moments. They sell, they lock in the loss, they miss the recovery. That gap between theoretical returns and actual human returns is one of the dirtiest secrets in personal finance. Studies consistently show that the average investor significantly underperforms the index they're invested in because they make emotional decisions at the worst possible times. Vanguard estimates that investor behavior costs the average person somewhere between 1.5 and 3% per year in returns. So, the stock market is not just a number on a chart, it's a psychological test you have to pass year after year for decades. Now, let us talk about real estate. And let us talk about it honestly. When someone says they made a killing in real estate, there are usually three things happening simultaneously that they are not separating out clearly. First, there is price appreciation. The property went up in value. This is the headline number most people cite. Second, there is leverage. Unlike stocks, where you typically invest cash, in real estate you usually put down 20% and borrow the other 80%. This amplifies your returns dramatically. If a $300,000 home rises 10% in value, that's $30,000 in gains, but you only put in $60,000, so you made 50% on your actual cash. That's leverage working in your favor. Third, there is rental income. If the property is rented, it generates cash month to month, ideally enough to cover the mortgage, taxes, insurance, and maintenance, with something left over. These three things together are why real estate has made many ordinary Americans genuinely wealthy over the past 50 years. But here's what rarely gets mentioned. Real estate is an operating business. Owning a rental property means you are a landlord. That word sounds passive. It is not. You find tenants, you screen tenants, you deal with tenants who pay late or not at all. You deal with eviction proceedings, which in some states takes 6 months and cost thousands in legal fees. You deal with the furnace that dies in January, the roof that leaks, the plumbing that backs up, the HOA that decides to assess a $4,000 special fee because they need to repave the parking lot. The National Association of Realtors estimates that maintenance and repairs cost the average landlord between 1% and 2% of the property value per year. On a $300,000 property, that's $3,000 to $6,000 annually, in cash, that simply disappears to maintain the asset. And, unlike stocks, you cannot sell 3% of your rental house when you need cash. Real estate is illiquid. Selling takes weeks or months, costs 5 to 6% in agent commissions, involves inspections and appraisals and title searches and closing delays. There's nothing fast about it. This is not an argument against real estate. It's an argument for understanding what you are actually buying. So let's do the uncomfortable math. Let's say it's the year 2000. You have $60,000 saved. You have two choices. Option 1, you buy a $300,000 rental home with 20% down. Over the next 24 years, U.S. home prices roughly triple. Your home is now worth $900,000. You made $600,000 in appreciation. Except, you also paid a 30-year mortgage at around 8%, which was the rate in 2000. On a $240,000 loan at 8% over 30 years, your total payments are approximately $528,000. You paid $528,000 to borrow $288,000. You paid $288,000 in interest alone. Add in property taxes, averaging roughly 1.1% annually on a $300,000 to $900,000 property over 24 years, conservatively somewhere around $80,000 total. Add in insurance, add in maintenance, add in vacancy periods between tenants. Add in that 1 year the property sat empty because you could not find a good tenant during a local economic downturn. Your net position is still very good, but it is not the simple $600,000 gain the headline number suggests. Option 2. You take the same $60,000 and put it into an S&P 500 index fund in January 2000. Bad timing, actually. The dot-com crash wipes out nearly half its value by 2002. You watch your $60,000 shrink to $36,000 and feel like a fool. But you hold because you committed to holding. By 2024, with dividends reinvested, your $60,000 has grown to roughly $320,000 to $340,000, depending on the specific index and timing. No mortgage interest, no property taxes, no emergency plumber calls at midnight, no tenant drama. You did less work, you had less stress, you also have less. That is the real comparison, not a dramatic winner, a trade-off. Now here is where it gets more interesting, because both of these analyses are missing the biggest variable: you. More specifically, your behavior, your tax situation, your life circumstances, and how each of these assets interacts with the way you actually live. Real estate has an almost unfair tax advantage in the United States, and most people outside the professional real estate world do not fully appreciate how significant it is. When you own a rental property, you can depreciate it. The IRS allows you to deduct the cost of the structure over 27.5 years, even while the property is actually appreciating in market value. On a $300,000 property where the structure is assessed at $240,000, that's roughly $8,700 per year in paper losses you can deduct from your rental income. This can dramatically reduce or even eliminate your tax liability on the cash the property generates. Then there's the 1031 exchange. When you sell a rental property and buy another one, you can defer the capital gains tax indefinitely. Real estate investors have been rolling gains forward for decades, building empires of unrealized taxable income that may never get taxed in their lifetimes if they hold until death and pass properties to heirs with a stepped-up cost basis. The stock market has the long-term capital gains rate, which is favorable, sitting at 0, 15, or 20% depending on your income. And if you hold in a Roth IRA, you pay no tax on gains at all. Both systems have been engineered by very motivated lobbying interests to encourage investment. Neither one is neutral, but real estate's tax advantages are deeper, more complex, and more inaccessible to people who do not have the knowledge or the advisors to navigate them. This is one of the hidden mechanisms that makes generational real estate wealth so persistent. It's not just that properties go up in value, it's that the gains move through a tax structure designed by and for people who hold real property.
Let us zoom out further, because there is a story about risk that almost nobody tells correctly. Most conversations about investment risk focus on volatility. Stocks are volatile, therefore risky. Real estate is stable, therefore safer. This is a profoundly incomplete picture. Stocks are volatile on paper. Your brokerage account balance goes up and down constantly. But that volatility is also your friend in a counterintuitive way. Because you can see it, you can respond to it, you can make informed decisions. The market is pricing itself continuously, every second, incorporating new information. Real estate appears stable because it is not priced continuously. Your house does not have a ticker. Nobody is making an offer on it every day, so you never see the bad days, but they exist. In 2008, home prices in some markets fell 40 to 60%. The difference is, nobody had to see that number update on a screen in real time, so it felt different, less scary, even though the actual financial loss was enormous for millions of people. And there is a category of risk in real estate that has no clean analog in the stock market: concentration risk. The average American's net worth is almost entirely in their home, according to Federal Reserve data. For middle-class homeowners, real estate represents somewhere around 60 to 70% of their total wealth. That means your retirement, your financial security, your life savings is sitting in one asset in one location, subject to the economic fate of one metropolitan area. If the employer that sustains your city's economy leaves, if the highway gets rerouted, if a new development tanks your neighborhood's desirability, your wealth takes the hit directly and fully. Stock investors in a diversified index fund own tiny pieces of 500 different companies across every sector of the American economy. If one industry collapses, the others absorb it. Your risk is distributed. Your neighbor who is all in on a rental property in a mid-sized city with a shrinking manufacturing base is not making a conservative investment. They are making a concentrated bet on one zip code. There is another layer here that almost never gets discussed in these comparisons, and it might be the most important one for young investors in 2024 and beyond: the entry barrier. In 1990, the median home price in the United States was around $120,000. The median household income was about $30,000. That's a price-to-income ratio of roughly 4 to 1.
Today, the median home price is around $420,000. The median household income is around $74,000. That is a price-to-income ratio of roughly 5.7 to 1. And in expensive coastal markets, it is 10, 12, even 15 to 1. With a 7% mortgage, the monthly payment on a $420,000 home with 20% down is around $2,240 before taxes and insurance.
In many American cities, that is higher than the rent the property would realistically command, meaning the cash flow math for new real estate investors in high-demand markets is simply broken right now. You buy the property, you rent it out, and you lose money every month while hoping appreciation bails you out. That is not investing. That is speculation. The stock market, by contrast, is available to anyone with $1 and a phone. Fractional shares, no closing costs, no down payment, no 30-year commitment. Accumulation is available to people at every income level in a way that real estate simply is not anymore. This is a structural shift in the landscape, and it matters enormously for how you think about which asset class is accessible to you right now, not in theory, not historically, but in the actual economic conditions of this specific moment. So what about the people who did it right? The ones who quietly, without headlines, built real wealth through real estate. Here is what they actually did. They bought early when prices and rates made the numbers work. They bought in markets that were growing, not already grown. They managed their properties professionally or learned to do it themselves without bleeding money to incompetent property managers. They used leverage carefully, never over-leveraging, never depending on appreciation to stay solvent. They understood the tax code and used it, and critically, they held for a long time through bad markets and bad tenants, and interest rate cycles and recessions. And here's what the quiet stock market millionaires did. They automated contributions, they held index funds, they ignored the news, they did not sell during crashes, they added more during crashes when they had the courage and the cash. They held for 20, 25, 30 years, and they did almost nothing. Notice what both groups have in common: time, patience, discipline, and an understanding of the actual mechanics of what they owned. The investment vehicle mattered less than the behavior of the investor. This is the uncomfortable truth the debate almost always skips.
There is one more thing worth sitting with. Real estate and stocks are not just financial instruments. They are different relationships to your time, your attention, and your life. The stock market, particularly index investing, is designed to be ignored. You set it up, you automate contributions, you let it run. The ideal behavior is almost no behavior. Boredom is a feature, not a bug. Real estate, particularly rental real estate, demands engagement. Even with a property manager taking 8 to 10% of your rent, you are still making decisions, reviewing financial statements, approving repairs, navigating insurance claims, considering refinancing, thinking about selling or buying adjacent properties. It is not passive in any real sense of the word. Some people love this, the tactile reality of ownership, the ability to drive past something and say they own it, the sense of control over a physical asset, the pride of maintaining something in the community. These are real psychological benefits that do not show up in a spreadsheet. Other people would find that level of engagement exhausting. They want their financial life to demand as little attention as possible so they can focus on everything else they care about. Neither preference is wrong, but neither group should pretend their choice is purely rational. It is also personal. Here is where most of these conversations end, with a tidy conclusion, with a winner declared. That is not what's going to happen here, because the honest answer, the one that actually serves you, is that this is the wrong question. The right question is not real estate or stocks. The right question is given your income, your tax situation, your risk tolerance, your time horizon, your local market conditions, your interest in being a landlord, and the actual economic conditions right now. Which allocation across both of these asset classes gives you the best probability of building wealth without destroying your life in the process? For most people under 35 in high cost of living cities, the math currently favors stocks. The entry cost of real estate is prohibitive relative to income, the cash flow economics are underwater at current rates, and the flexibility of liquid assets has enormous value when you're still figuring out where your career, your relationships, and your geographic preferences are going. For people in their 40s with stable income, established credit, and the desire to build something leveraged, rental real estate in markets where the numbers pencil out, meaning rent covers expenses with positive cash flow from day one, is still one of the most reliable long-term wealth-building tools in American economic history. For people closer to retirement, neither asset class should be treated recklessly. Leverage amplifies losses as ferociously as it amplifies gains.
Here is the thought that stays with me when I look at all of this together. There are roughly 48 million rental housing units in the United States. A significant portion of them are owned by individual investors, regular people who became landlords. And there are roughly 60 million Americans who own stock market investments outside of their employer's retirement plan. These two groups talk past each other constantly, each convinced the other is leaving money on the table, each citing the numbers that support their own story. But the most sophisticated people in both worlds quietly hold positions in both because they understand that the debate is a distraction, that the real game is not picking a lane, it is understanding the terrain well enough to move between lanes as conditions change. The question is not which asset class wins. The question is whether you understand what you own well enough to hold it when things get hard. In the further question, the one that does not have a clean answer, is whether the conditions that made either of these assets legendary in the past 40 years will persist for the next 40. Interest rates, demographics, remote work, urbanization, tax policy, generational wealth transfer, the private equity firms that now own over 600,000 single-family homes and are buying more every quarter. The board is changing. The people who understand that will adapt. Everyone else will be citing numbers from a decade that no longer exists.